Hello, and welcome to our market alert video for today, which is October 20, 2023. I am Ken Moraif, and I am the founder and CEO of Retirement Planners of America. And we have a goal, which we consider to be a noble purpose, which is to create as many squippers as we possibly can. And if you're wondering what a squipper is, the squipper is the acronym for second childhood without parental supervision. So when a client of ours retires, we call them a squipper because we want them to go play, have fun, and get out there and start squippering. So our website is rpoa.com if you want to find out more. So let's talk about this week. Kind of an interesting week. We had on yesterday, Jerome Powell, the Federal Reserve Chairman, gave a talk at the New York something. And the interesting thing about it is that before he gives a speech, they released the transcript to the speech, and the market was up upon reading that transcript, liked what it read. It was good. We like this. And so then he gave his speech, and during the course of his speech, there was some volatility, but generally the market was up. But then after he gave the speech, he gave an interview. And during the interview, boy, howdy, the market apparently did not like what he had to say because it went down from there. The day ended down. And as I record this, the market's down today as well. So what's going on? What happened? Well, basically, as we've been saying since the beginning of this year, practically, we thought that inflation would bottom in June at about around 3%, which is in fact what it did. And then we said it would trend back up towards 4%, which is what it has done. It's at 3.7 now. And we think that it'll peak in December. But then it'll start going down next year because of the efforts that the Fed has made. And we think it'll get to 3% probably towards the middle of the year and kind of stay there till the end of the year. So it won't get to the 2% that the Fed is looking for. And that's what Jerome Powell, he didn't say that, but what he said was that interest rates will probably stay high for longer than people expect. Eek. Well, that's what we think too. That's what we anticipate is going to happen. Because if they want to get to 2% and they're at 3%, it's not time to start lowering interest rates yet. And the people who thought that we're going to start lowering interest rates did not like that. That's not good. We thought interest rates were going to go down. We were betting on that. And so that's why we see this selling in our view. Now, this correction, we called it inflation shock, is actually happening as we said it would and has been going on since July. And we think probably it's got another 3-4 weeks to run before we get to the end of it. In November, the hint from Jerome Powell was that there will be no rate hike, but the hint was that in December, there will be a rate hike and that then it'll stay high for longer. Our view is that probably December could be their last hike, but they're going to keep it at that level probably through the entire 2024. And that's bad news for people who are betting the opposite, but it is good news, we think, for the stock market, because once the rates stabilize and we have some sort of certainty around it, then companies can operate within that. They may not like it, but they can figure it out. We have very smart business people in our country. And that being the case, profits will stabilize. Investors will have confidence, and we think there'll be a rally in stocks. The other side of the coin is bonds, and we continue to think bonds are a very risky place to be. If you look at the bond market, the bond aggregate index, go back to April of 2020, the pandemic, and pretty much for 3.5 years, the bond market has steadily been going down. But it's been a kind of a steady decline. And so we don't think it's time to go back into bonds yet because, again, the Fed is probably, in our view, going to raise interest rates one more time, if not more. And if that's the case, bonds won't like that. So we currently are counseling our clients to be in money market fund with the bond portion of their allocation. And money market funds currently are paying around 5%. So why not wait out the bond storm, the worst bear market in bonds since 1787, not 1987, 1787. Why not wait that storm out? And as you guys know, we've been out of bonds since April of last year, so we've avoided a lot of the carnage that has happened there. Our view is that probably it'll be March-ish before we start thinking about going back in, but we'll keep you posted on that as time goes on. So if you're in a 60-40 buy hold situation, you've probably been suffering quite a bit here over the last year, I would imagine. And we don't want you to do that. So go to our website, visit with one of our retirement planners. We'll talk with you about our strategy to sell stocks, which is the one that told us to sell in November of 2007 before the 2008 crash, told us to sell in April of last year, and you know what happened after that. And also to talk with you about our bond strategy as well. So don't be a buy holder. We don't think that's a positive thing to do for somebody who is over 50, who is retired or retiring soon. So our website is, you can click below, or you can go to rpoa.com. Thank you for watching this video. I hope you are well, and share it with your friends, share it with your family. We want to help as many people as we possibly can. Okay, so we'll talk soon. Thanks.